Okay, welcome back, fellow trend following traders. Sorry for the delay and for not sending out that reminder this morning, but thankfully I did set up the spaces a week ago, so I think we're in good shape. I've been traveling around Tampa, New York, now Virginia, so more travel tomorrow, but no trouble. I always enjoy getting together with everybody Friday morning. Rough week. Wow, what a bad week for long-term classic trend following. This week is a good example of the uncomfortableness of loose pants trailing stops and how this would motivate anybody and everybody to want to do a bit of vol management. So, yeah, getting out of some of these trends as they reverse them, especially the grains, I guess. Yes, I guess the base metals were tough as well a few weeks ago, but other things were kind of making money, so it kind of didn't hurt so bad when copper, aluminum, zinc, nickel, lead, tin all reversed. But this week the grains were pretty nasty, and I trade more wheat than anybody on the planet, so they were all the worst, and then a bit of energy, I guess, but that's still to come for me. I'm still fully 1,000% long crude, heat, unleaded. And so anyways, yeah, really, really tough performance week. Makes you wonder why do I do this? Oh yeah, I had that back test. So the back test, I trade the best exits that the back test shows me. So there you have it. And the back test really loves long-term systems over a 20, 30, 40-year back test. Not this week, though. Did not like them this week. So anyways, yeah, hopefully you guys did better than me. Okay, so let's bring some people up to talk. Oh yeah, let's keep your responses to about a minute, so we can keep it flowing. And of course, that rule doesn't apply to me. Probably doesn't apply to Rich. But everybody else, try to keep it to about a minute. And let's, if you want to talk about something, bringing up vol management again, Rob again, that stuff. I know we could probably say a few things about that, or whatever's interested. Let's try to keep it going and keep it moving. And I'll let, as usual, we'll let Oleg start. How you doing, Oleg?
Hi to everyone. I'm in transport now and maybe will be there in 10-15 minutes, but I am totally focused on our conversation. It's, as always, say, very happy to be here. And I want to say that, yes, this week was tough for most of us, but it makes me happy because, as I always say, it's a part of the process. And if there was no such week, such maybe month, this give back of profit, there wouldn't be our big profits, our systems, our happy conversations about the market, maybe our trend following, great trend following philosophy that we can apply to a lot of different fields in our life. So it's one of the one side, it's a tough week, but it's a happy week because it's a part of our happy process.
G'day, Jerry. G'day, everyone. I was just going through the returns for the CTAs for June. As I'm sort of doing that report with Neil, and June was a pretty good month for the CTAs. But Jerry, yes, you're right. This last week, the energy sort of smacked me around a bit, but and also what was it? Cattle gave me a bit of a sort of a bad time as well. But yeah, look, it's not greatly damaging this week. I tend to say that the portfolio is stagnating rather than going backwards, but I suppose depending on what you're holding in your portfolio, obviously, therefore influences the performance returns. But it's been a great year so far, and to have this small sort of small movement, adverse movement this month, I treat it with a grain of salt.
Yeah, it's in the real world when you're dealing with the markets, you can sort of see how looking at a back test, you can be very committed to doing all the trades and following the systems and letting the profits run, and then when they all reverse, you can see where people will really try to add some other features, vol management and correlation management to the system. So it's really, but some of these markets may turn around, and the final decision in P&L hasn't been decided yet. So I think my performance is going to be much different than other people because of no vol management and letting the profits run. And in some of these grain markets and metals and energy, the ATR is so much larger now than when I put on the small little trade back in 2020 and was risking 20 basis points. Now the thing has exploded into sort of like a bomb that crushes everything in its wake. It makes all the profit when it goes up, and it gives a lot of it back when it goes down. So it's kind of funny how you can trade small, and because trading 200 markets and risking 20 basis points, you're like, how are you ever going to make any money? And then you can see what happens. These little tiny small trades become these gigantic outliers profit-wise, and then ATR-wise as well. The ATRs just start to expand, even with this kind of overly conservative trade level calculation we do, which we don't use current equity for the trade level. So the trade's even smaller. It's based upon closed equity and not the rip-roaring open trade equity. So, but yeah, it's just like Oleg said, you love it on the way up, and then you have to deal with the issues on the way down. But I think that, and then you have the relative performance. We make fun of stock people who love to have the majority of their portfolio be in equities, and a lot of that is due to peer pressure and peer relative performance. If we're all down 45% or if we're all down 20% for the year, I'm going to feel a lot better. But I definitely have staked out a different way with, about 65 commodities, 65 stocks, 40, 50 currency markets, 35 interest rate markets. And so in my 200 markets, I want to have better performance and see how to maximize trend following per se. And so I'm going to have better and worse performance than the typical CTA. So, which is, in my opinion, it's fine. I'll deal with it, and I'll love it most of the time. And those 200 markets, for me, I don't count the stock indexes, the short stock indexes. I don't count those in there. So I'm up to 235, 40 markets probably. But yeah, so maybe 300 one of these days. I found some interesting stocks recently. There was an article in the Wall Street Journal yesterday about this special sand. There's a shortage of sand. I think it's in Texas. It's a byproduct, or they use it in drilling for oil. So I just looked up these companies. I found a company that trades publicly. So now I'm long sand. well, I'm not long yet, but the sand companies in my portfolio, I found a French fry company, like one of the largest French fry companies publicly traded in the U.S. So now I am long French fries. So much fun adding in some of these other markets.
The joys of
Uh,
having large amounts of capital. I love it, Jerry.
By the way, it's very interesting. It's very interesting to add these markets. I understand this because people often say a lot about different trading system, different approaches, about targeting global macro and other things, of combining with the classical trend following this strange stuff, but I think it's more useful and more evidence based to add another different markets, maybe even exotic markets, if it's no problem with the liquidity, and it's really a more powerful tool to add more markets here. I'm pretty sure.
One thing I wanted to bring up now or later, maybe Rich, we can think about this. Maybe I'm making too much out of this, but I wasn't, incredibly impressed with the paper that Rob wrote. I mean, I'm sure it's a good paper, but honestly, the paper that Rob wrote about the volatility management, most of those conclusions that he came up with, I agree with. And have said many times that I agree that it was kind of one of my main points is that in order to get more profit out of all management type systems, you must measure the performance in terms of Sharpe or vol, and then you have to leverage up. It's going to kind of underperform. If Classic buys 50 contracts and vol management, of course, it buys 50 contracts as well, then the life of that trade is, for the Classic, is it gets out with a long-term exit. The life of the vol targeting trade, vol management trade, those 50 contracts, they fluctuate the whole life. Vol goes down, they buy more. Vol goes up, they sell. So there's multiple trades in between. And then I guess finally they exit at that same breakout. And that's the way I sort of ran the test. So it makes a bit less money. It's much more smoother. The Sharpe is much higher. And then you have to leverage it up to make the same amount of money that Classic made with those same 50 contracts. That's not how Rob ran the back test, of course. But no one sort of disagrees with that conclusion that it's more efficient to vol manage, irrespective of the validity of the back test and the sample size and things like that. However, that's not where I wanted to go. The point I wanted to make was that some of the critics, these people read Rob's book and they become kind of devotees of Rob Carver and the book and stuff. And so they kind of went after Rich and me with their rude comments that were totally unfounded. And Rob half-assed kind of acknowledged it on TTU. But anyways, their point was, here's all this perfect evidence, and why don't you agree with Rob now? And then, so I think that regardless of, you're always faced, when you do your own back test or you read about other people's back test, you have to ask yourself, do I really like this back test in the sense of the sample size and the parameters and everything about the back test? I know Rob does that too. You sort of ask yourself, is this a good back test? You should be asking yourself, have I got too many parameters, too much overfitting and things like that? So it's just a normal question that anyone would ask themselves and others, the legitimacy of the back test. And so then compare that. So that's why when people say, why don't you just love this back test and agree with it? It's evidence. Why are you acting like in a religious manner that you refuse scientific evidence? Well, you have to sort of dig a little bit deeper and make sure that you're happy with all the assumptions. But anyways, I want to compare the skepticism or lack of skepticism to back testing with that article that Mark Rozimski wrote about outlier systems and distributions that have you can't measure the mean, and then so I followed up with Mark and said, how does this impact back testing when so much of the back test might be these crazy distributions of very large outliers? It seems to me that this would call into some sort of question statistics of back testing, because these outliers are so crazy and they dominate the performance that your confidence on what this back test means for the future would be a little shaky. I mean, what do you think, Rich? Does that make sense?
Yeah, it totally does, Jerry. And the point I'd like to make is this: that there are a lot of people that think that it's being scientific to use a back test as a basis to validate an argument. And, I generated a tweet early on after Rob's great work. It is great work because it certainly does use a back test to validate his conclusions. I've got no argument against any of those conclusions that Rob made. However, we are not targeting the same edge that Rob is targeting. He's targeting the edge that resides in, that approximates the normal distribution. We are targeting the edge that exists in the outliers. So Mark's paper really hit the nail on the head when he said that perhaps in the real world, these distributions aren't normally distributed. Perhaps they approach a Cauchy distribution. Now, that's the argument we've been saying all along, Jerry, for many, many years. That's what a trend follower believes. And when he talks about robustness, he's not talking about robustness in relation to historical performance. He's talking about cutting losses short and letting profits run. It's a particular design response that manages uncertainty, basically not necessarily what the history has given us, but what all possible futures could possibly give us. And the safest argument we have is a design statement that says, whenever things go against us, we cut those losses short, but we leave the opportunity open for any opportunity that the market brings. And the same argument, there was a big argument in science, and this is what I wrote after Rob's, just to demonstrate that scientifically, it's not wise to use the back test as a basis to validate an argument, because the back test is simply a single path, a single historical history of events, a sequence of events. And it's the same argument that Newton fell into when he developed his gravitational laws. He developed his gravitational equation, which is the one we learned in school, based on the evidence surrounding the earthly domain. In other words, the gravitation that exists around Earth. And he developed his gravitational formula, and it worked incredibly well in that domain. In fact, it's still used today in that domain. However, Einstein came along and said, hey, look, you've based your entire principle on a back test, basically a back test that surrounds that domain that you exist in, that earthly domain where gravitation is fairly weak. But what happens when you start getting into an exotic domain, which is very unfamiliar to what your history has experienced? What happens when you approach, gravitationally dense objects? And what happens when your speed is approaching the speed of light? Something really strange happens with gravity. And that's effectively what we're saying with our Cauchy distribution. We're saying that historically, Rob's argument is totally supported historically. However, we're saying for robustness reasons, we can't rely on the past as a gauge for the future, and therefore we need something else. We need a system design statement that protects us for new experiences, things that we've never experienced before, because the thing that we can be guaranteed with complex adaptive systems is that they adapt. What that means is that things that appear to be normally distributed over a very long-term time horizon. So, if we go back over the history of the Dow Jones over the last 125 years, you'll see that there was a 92% drawdown in about 1920s. That's what we're saying. We're saying that history, well, the future can present environments that we haven't experienced in the last 30, 40 years, whatever the backtest has experienced. So we need to protect ourselves. Now, our solution actually does give us the best CAGR in these sort of exotic regimes, because the normal distribution falls over when you start getting out to the tails. And so what happens, this is what Mark's paper was basically saying, is that if markets resemble a Cauchy distribution, any assumption, statistical assumption that is guided by the central limit theorem, which is a theorem that basically gives validity to all of the statistical measures that most traders use, like Sharpe ratio, all of these different ratios developed by economics over the past 30 years, is dominated by assumptions of normality. Now, when the central limit distribution breaks down, as it does in the Cauchy distribution in these extreme tails, that means that there is no singular mean, there is no standard deviation we can use as a guide to volatility target our models or whatever, because when power laws start influencing the state of affairs of a market, you get these exceptional, exotic moves that potentially can be unlimited in extent. The only thing that stops a stock going, to infinity, well, that theoretically it can be anything. There might be sort of boundary constraints like $0, which prevents a market from really going too far away from zero, but they're asymmetric, they're open-ended. And this therefore means that profits potentially can be unlimited. And therefore our models that we profess are the best models to use are the specific ones we use for trend following, which is simply a scientific statement.
Yes, to add to it, I just wanted to add that the leptokurtic nature of the Cauchy distribution is something where two things are not considered at all. Number one, if when you get into the tails, when you start having either a positive skew on one side or negative skew on the other side within that subdomain, then as Richard mentioned, those aspects would basically just fall apart. And for that, somewhat of a different lens is required. And as Richard said, from the true trend following mechanism, one has to always keep this in mind that, hey, does this market in this current regime have a positive skew or negative skew? And that's how one has to even structure sometimes how one ends up trend following, or the measures to use in order to measure the effectiveness and efficacy of the process.
And I think about the backtest, I want to say that theoretically we can do a backtest of a particular system that will be performing very good for maybe 1,000 years. Theoretically, of course, it's very low probability. I mean that I want to say that. And after a few months, after we have done this backtest, our system will be blown up, will be ruined, because of changing the market regime. Of course, I'm talking about theoretical my thoughts, but I always say that we must understand the logic behind the system, behind the strategy. We must have arguments behind this. We must have a scientific approach, like Richard said, and like Jerry said, we must take as little as possible from the backtest, the main things from the backtest, and it must be objective. And when we are talking about a lot of systems like global macro and something like that, as for me, I don't understand how to do a backtest in a proper way in such system. And I understand how to do a backtest in a long-term trend following. I understand this. And because of it, I trust such a backtest.
Hey guys.
Hi guys.
Good morning and good afternoon, everyone. Maybe just.
I do have two points to raise this week. Number one, I trade trend following, but on the short-term side. And this week, I was making money on the energies, so it's possibly a good way to diversify on the long and the short on the medium trend following strategies, which is one of the key things for me. But definitely the short term side was making money on the energy suite this week. So that's point number one. The second point is about the volatility management. Now, I have coded volatility management into my backtest process, and I have tested it. And basically, I was cutting my winners short to see the impact. And all the time, whenever I do that, I lost money. So the CAGR wasn't as high as just leaving those winners intact. So when we talk about the fact that backtests, do not actually support this, or trying to say esoteric approaches around volatility management, I mean, in my research, in a code, whenever I cut the winners, almost all the time the CAGR is lower, and all the other ratios might be much more smoother. Your drawdowns or your Sharpe ratio or whatever. But if I just focus on the CAGR, and I've tested it, I couldn't see any instance over many years of testing that when you do vol management, your CAGR is going to be higher than without vol management. So if anyone else has tested it and if actually contradicts my observation, I would love to hear that. Thank you.
Yeah, I agree. I couldn't say it better. And I'll just follow up because I think one of the things that I like to do is just as soon as someone says something like that.
Hi, sorry,
Jerry, we can't hear you.
we can't hear you.
Okay. Can you hear me now? Can you hear me now?
Yes, Jerry, we can.
Okay.
Now
Yeah.
it's
So
better.
yeah. So as soon as someone makes a good point in our favor like that, I want to sort of follow up and say, but if vol management people were speaking, so I'm going to speak for them, and they would say that the vol management system, as the previous speaker said, it's smoother, it has a higher Sharpe ratio, so we leverage that up. That's totally normal. That's what people do. When you have a portfolio, if you trade 50 markets, classic trend following, you're going to trade 4 units of maximum risk, let's say. If you trade 250 markets, classic trend following, maybe you'll trade 5 units of max risk because the system is smoother. And it's done by adding markets, but you can also make it smoother by vol management. So that's what they would say, that we can pick up these returns because scientific traders, they increase their risk as the Sharpe ratio or the efficiency or the drawdowns become smaller. We can take on more risk. And CTAs, that's a cornerstone of what every CTA and futures trader does. But however, the downside to leveraging up your portfolio based upon vol management is your average loss will be a little bit higher. So you've defined open trade equity as now risk, and which I don't think it should be. And then you have a major average loss a little bit bigger, which is going to have a negative impact on your capital and your losses. So anyways.
Hey, everybody, it's great to be here. Good morning and good afternoon, everybody. Just 2 comments as an observer, and I haven't been in the trenches with you guys on the Twitter debate. I was just reading through it or skipping through it. What I found, and I have 3 points to make. The first one is I found it relatively surprising that the scientific test that we think, even we as trend followers think that should be done in order to prove one side right and the other wrong, is a test that focuses on CAGR and Sharpe ratio. I mean, since when is this our lingua franca? I can go to my computer right now and put a bunch of overlays onto my lovely pic that doesn't have lipstick on, which is my trend following system. And a lot of these overlays will result in a higher Sharpe ratio and a higher CAGR. That doesn't mean that I will turn them on. I will not turn them on. So since when is this single-minded or focused measurement of just because the CAGR is higher and the Sharpe is now higher on a vol controlled system? And I have another point to make, which is to explain why I don't think that's true. Since when is this really therefore now proven that this side is right? I just don't get that point. Then the other point is two more points. Many years ago, I was running some tests, and so what I did is I did it market by market, and I don't think you guys have done that. I don't think Rob has done that. I'm not sure, Rich, if you have done it. I'm not sure if anybody here on the show has done it. But when I did it market by market, so I go through all those, let's say 100 markets that I have in the portfolio, and as soon as I have a trade on, then on a daily basis, I would control that trade as a function of historical 20-day volatility. I was actually using the higher of the 20-day and the 100-day realized volatility. And if volatility increased, then I would take the position size down and vice versa. What I remember, and this is now years ago, is that this has worked phenomenally well in bond markets. Bond markets have, for the past decades, I mean, maybe this is now different, they had a massive uptrend. And every time they trended up, kind of like volatility came out of these markets a bit. I mean, yeah, there have been episodes where it's been a bit more volatile. But if you step back, if you look at like a very long-term bond chart, the only thing that you can see is going up and it's becoming less volatile. It's clearly becoming less volatile because yields are going down. I mean, you can see the ATR of any short-term interest rate futures contract come down, right? So this up leverage that you're creating through vol targeting has worked miraculously well in the fixed income sector. Has it worked well in any of the commodities? And I treat them separately, like do it on lean hogs, do it on lumber, do it on orange juice. I don't remember that it has worked well. In fact, it has probably detracted from performance. This is my memory. There was a slight positive effect that I could see on the equities. But, equities, again, over longer periods of time, they do go up. We make money on, the long-sightedness of these positions. And when they go up, the volatility tends to come down. And you kind of like pyramid into, maybe the wrong word, but you kind of like increase your position into that uptrend. So those are really, I didn't see a positive effect in currencies. So that's the second point. And now the third point, which to me is completely weird, and which I just encourage you, if you listen to this, and if you think nobody needs to think like me, but that to me is I didn't even want to spend any more time on this, because this point I'm now making made it very clear to me that I'm going to switch it off and never going to switch it on. Is I now run a portfolio, and when I put all of these vol control things together again, then I'm now dependent on the correlation structure that exists in the portfolio, because I'm also going to volatility control the portfolio, right? There's no point to just say I'm going to increase the size of my fixed income positions and I'm going to keep everything else unchanged. If I do this, then my overall portfolio volatility will now have increased, And so what I do is, in a lower volatility environment, for instance, for the bonds, I'm increasing the bond exposure, and maybe I need to increase all of the other positions now again, because the correlation takes the volatility down. And so then you observe that you're actually increasing positions in situations where you have absolutely no business of increasing it. So the last thing I want to do is see a position where I entered the position and I'm approaching my initial stop, so it looks like this is going to be a loser. Let's say I'm 10 basis points away from being stopped out on that trade, and I want to realize a 1 R loss or a certain number of ATR loss, because that's my expectancy. That is what I want to systematically realize over time. The last thing I want to do is 10 basis points before I get hit out of this position to increase my position size, not even by one lot. I mean, this to me is so against what I have chiseled into my brain that I want to do until the end of my life, that the buck stops here. The discussion is over. And I don't care if the CAGR of any vol control system is higher. Go away. Sorry about that.
That's fantastic, Moritz, because you're bringing up some great points, and I'm going to respond to your points as somebody who uses vol targeting. Especially the third point is a very astute observation, and I'm going to say yes, you're right. I mean, you are sort of forced to do that. You're forced to adopt a correlation structure, so you have to move away from the trade to the portfolio. Doing vol targeting presupposes, i.e., one of the fundamental assumptions is that you don't care about a single position, you care about optimizing the portfolio. That in turn takes, forces you to think about geometric returns, vol drawdowns, and then, as Jerry said, adjusting your leverage to the amount of volatility you have in the portfolio, because that's the only way of compounding at a higher rate. So it is a weakness, like every approach has its weakness, and you're trading positive skew. If you didn't want to go for vol targeting, you would have a more positive skew in a classic trend follower, but you're going to have higher volatility at the same level of position. What do I mean by that? I mean that as your ATR explodes, it controls your P&L. So you're going to have a handful out of the 200 position that Jerry has. I'd be pretty sure that if I were his P&L analyst, I would always single out, a handful, maybe 10, 20, that drive the portfolio and everything else in the background. So, the vol targeting sort of, levels everything at the beginning of each day or at the beginning of the period. Very briefly on pyramiding, this is a point I made to Richard before. This is true only in theory. What do I mean by that? It's absolutely true the way you describe it, but I think reliable and modern vol targeting systems cannot function outside a continuous signaling mechanism. So you're adjusting your positions up and down as the signals become more or less strong. And in my world, I define signal strength based on precision of measurement. So how much I think that I'm capturing of the signal versus when it gets very noisy, I tend to downweight the signal. So it's a more complicated approach, but I think and this would be my critique to Rob's post. I'm a nobody, so I'm an avid follower of Rob's work. But I think what is done in this particular post was sort of setting up the lab to prove a point, which is probably not how you should do things like that. And that's why last week I said we shouldn't really settle this type of argument based on backtests, because it's really hard to prove. But I think Rob should have given two views of the world: the classic trend follower and or the fully continuous signal and vol management, and sort of pitted the two against. He's decided to divide up his grid in 4 subsystems, and I think that Richard said, I'm like system 3, so I'm doing everything apart from continuous signals. So it just sort of lets people, mix and match and choose sort of, how things should be done and what they want to prove. So I think it's been less, clear and less Rob-like and less precise than usual. But once again, I think his work was pretty good. So hopefully I've addressed some of the points. It's really a hard point to settle on a debate, because it's like, how long is a piece of string? But I know that I keep saying that there's no right or wrong. Jerry doesn't like that, but I do think that there's no unique way of settling this.
Yeah,
hopefully I've given you some.
No, that's great, Bruno. I have another suspicion, and I don't have the data around that, but I would maybe place a little bit of a bet that the analysis that has been done, or the way you describe it, is kind of like a very long back test, and then you compare the CAGR and the Sharpe ratio of a 30 or 35 year back test, vol controlled versus non-vol controlled, and you say one is better than the other. Okay, so this is a very long period of time. What about, just as a thought experiment, right? In, say, 30 years ago, or even longer ago, when Jerry started trading in these markets, there weren't 200 markets around. It was, much more focused on the commodities and much less focused on the financials. I'm not sure when they launched the S&P 500 futures contract, but, many, we know this from our back tests, right? I mean, decades ago, there wasn't a Bund futures contract. You were trading oil and corn and wheat and these type of things, and really here what I think you can see is that these type of markets, they have, and Rich is talking about the outlier, they have more of this weirdness, the non-normality in their distribution. Look at power and gas prices this year. It's a perfect example for that. I'm picking it, but kind of like there's every year you can look into the commodity markets. Lumber last year, right? Every year, I mean, oil the year before going negative. Every year there's something crazy and lopsided going on in the commodity markets to an extent that you wouldn't see in any of the financial markets. So how about you look at the results on a market by market basis? I would encourage Rob to do that. I would encourage Richard to do that. Or just, look at the period, say, when Jerry started trading as a turtle with Richard and Bill. From that point onward, say to 1994 or so, right? I mean, for this 10-year period. And see just for that 10-year period whether vol trading would have improved the portfolio or not. Maybe it does, but maybe it doesn't. I think it would give you a different perspective as to what you're looking at. And again, to me, it's like, Rob can show me whatever higher Sharpe ratio he wants to show me. It doesn't. The thing is, I'm trading a system, and the way I want to, trade the system is I want to be repetitive and boring and stoic in this approach, and play it the same way every day. So I think we've said it before. Like, you go to the blackjack table. If you were a card counter, you would have a system, and you would play that system, and you would have to play it in exactly the same way, maybe with a Kelly criterion type of position sizing, which is our ATR position sizing, if you want to use that analogy. You would need to play it in exactly the same way in order to, to crystallize your edge and make money. So I just don't understand why I would change the way of play, change the way I trade my system at a blackjack table or in the markets, only because some market has moved a little bit different or has changed its volatility profile a little bit, or because the correlation profile between markets has changed. I'm still playing the same game. So, yeah, look, I'm not going to do the work on this. I refuse to do it. I refuse to do the back test on, I've done it many years ago. I just, I'm sidestepping this, and if people want to trade vol control systems, hey, it's a free world. Do it.
Yeah, I agree with all of that, and I think that, but I think you hit on the right point, which is, it's outside of the back test, and that is, to what degree are you messing with your edge? And that's the ultimate point there. I've never said, although I do believe that the sample size is a problem when you use vol management, but I have said that it's difficult to count it. How do you count it? Like, both the classic and vol management goes long 50 contracts, and then multiply this times thousands of trades. At the breakout, they both go long 50 contracts. The classic gets out a year later and sells those 50. The vol management system sells 5, buys 10 back. I mean, it's doing multiple trades throughout this 1 year period, and they're being determined by some sort of vol management or portfolio. And can you count those, and how do you count them, and which bucket do they go in? I mean, it gets really confusing. So I think messing with your edge is the ultimate, and that you can do the best back test ever, but how did you count your sample size? And that's where it really gets subjective. Everyone's going to have a different opinion, I suppose. And then number two is, we are absolutely saying, at least I'm saying, ignore everything that happens until you exit. You enter, you exit, nothing happened in between. The vol, the give back, the profit give back, and all of that movement, and then multiply that times 50 markets or 200 markets, and we're basically saying, I don't care. I have maximized my sample size from the back test. I'm going to let all hell break loose like this week in the grains. And my average trade is 3 to 4 ATRs, and that's all I care about. And they're saying, "What? Are you crazy? We're professional money managers, and we have to worry about each day and all of these trades and this volatility. We can't close our eyes. Is that proper money management and risk control and risk managers? Are we doing a good job by saying, I'll look at this trade in the year when it exits?" And psychologically or professionally, they have a hard time agreeing with that, and I totally understand. I understand. It does seem kind of crazy to do it that way, but I think these are the issues. But this week, I've often said that I'm skeptical of vol management being primarily risk management because it really fits in well when you figure out in the late 90s that shorter term trend following doesn't work very well. And we have $5 billion under management. That's what they're saying. We have to move out to these longer term moving averages, longer term breakouts, and we're going to get destroyed on some of these drawdowns. So, how do we overcome that? And that's why I think that they overlay the long term with vol management, and you don't have weeks like this because when the grains peak out on the ATR, you have stripped off so much of that position that when you wait until these long-term exits to get hit, you have very little left. And so it really does benefit not only risk control, but also profit taking to some degree because, it's easy for me to say, well, I'm just going to live with those drawdowns. And they're like, yeah, you can live with them, but we have 5 billion, we're going to 50 billion, and we're not going to get there if clients have to sit through volatility while we maximize these outliers. And so, as Rich said in the beginning, they're not doing the same thing we're doing. They're not targeting the same trades.
Yeah, that's true. I mean, the biggest pressure is called mark to market, and unfortunately, whether you consider your closed equity or your open equity, when your broker sends you a statement that says, you're down X relative to yesterday, and you're sort of subject to public scrutiny, you have to do something about that. Either you convince your investor base that that's okay because it's all open equity and it's all going to come out in a wash, which, from a theoretical argument, I agree with, I second. Unfortunately, I have not that commercial power to make investors or third parties happy with that. So I will have to do something else, and that's why I think vol management helps. But I don't want to be the vol management evangelist and say, oh, it's the end of it's the cure of all evil for all evil, because going back to what Moritz was saying, it was a very subtle and very sharp point, which is, hey, what the hell are you doing messing about with a correlation or a volatility structure? I mean, you've got conflation between on-diagonal and off-diagonal elements, and you're doing trade based on certain things which are down to pure market noise. So that's a very, very, very good point against vol management. But I think this would be the point I'd bring up if I were to debate it as a weakness, rather than vol management sort of prevents you from taking the asymmetry and the positive skew inherent in trend following, because I see it in portfolios. I mean, I get on trends and I stay on them, even if volatility expands, because there's ways of buffering continuous trading. There's ways of limiting some of the elements that you guys talk about, as well as extracting convexity from trade. So did I have a bad week this week? Yes. Has it been horrible? No. What happened? Well, as things sell off, you are forced to close positions. So the first 1% price move may be a little painful because you are loaded up with contracts. But then as volatility expands and signals sort of dampen, the second fall is less and less and less acute and severe. So yes, you will have to re-enter at higher ATRs, and so you sort of unlevering your potential for the next leg. But again, it's sort of, if the leg is really powerful, you're going to make less money than Jerry and you guys, but you will participate in that second and third and fourth leg up. So again, these arguments I don't think can be solved and settled by a backtest. And like Moritz said, I'm not going to be the guy that tries to settle this debate because it's very, very difficult to prove scientifically. It's all down to a matter of personal choice and preference. And at the end of the day, it's about philosophy more than science, I think.
I think that a mindset of a successful person in all fields, it's a mindset of a person who operates in a longer term, I think. And a lot of factors like clarity, like Neil said, that our system is very clean. We understand where we enter the trade, when we exit the trade. We can backtest all this in a good way. So, and also we are responsible for our decisions. So on the other side, in one side we see the short-term space, this vol target and other stuff, and on the other side we can see passive stocks. And in passive stocks, people are not so responsible, I think, because they only wait something, and it's not a very good approach. And we make our clear decisions, and we have a long-term mindset, long-term view. So I think it's very important.
Hey, hi everyone. Thanks for the space here, Jerry. Once again, it's amazing what we do here. And I'd like to chime in the question you just posed on how do we count this vol targeting trades. And from what I learned from reading Rob's books, it's a different way of counting trades and performance. And we on classic trend following tend to count on trade by trade and compare statistics of individual trades and calculate our statistics and evaluate the performance of the system on that basis. But this, let's call it new trend following, it doesn't do that. It looks at daily performance or weekly performance or monthly performance. Anyway, counts performance on a time basis. And I think it's from this week's podcast with Niels and Rob that he says that his system is never entirely off. It's long on the long side or the other times on the short side, but it's never off. There is not a moment where you can ask Rob and say, Rob, where did you enter this trade and where did you exit it? He never does it. He's always changing the size of his position based on what he sees the market. But there is not a moment that he says, oh, this is an entry and this is an exit. And for me, this is extremely hard to evaluate, because I cannot trust that monthly performance is of. There is not a hint of independence between monthly performance. Therefore, I cannot start to calculate any statistics on that. So I have to start to think about autocorrelations of performance and think about how a day affects another, or how the performance of 1 week affects the performance of the next week. And well, statistics get really much. That's another reason why I'm firmly on the field of counting trades and not counting P&L to evaluate how the system's going and take the next step of vol targeting.
And you can see how confusing it can get. In my example, both strategies buy the 50 contracts at the breakout, and then the vol management will subtract some contracts as vol increases, and then maybe later vol decreases, and then it adds them back. So when it subtracts and adds, are these new trades? Do they have a stop loss? And you can see how confusing this can get. So that's why I think when you listen to some these type of about some of these strategies, they'll say, well, we don't have stop losses. Okay, yeah, I agree. I mean, I don't know how you kind of keep track of, all these buys and sells. And so maybe you have a threshold where you don't you don't adjust every day, but it has to be like 5 or 10% greater. The position needs to be adjusted by 5% or 10%. And then if it's less than that, you don't do anything. I have heard of some people.
Jerry, I'm finding it hard to hear you.
I have heard of some traders that only trade, that only reduce positions, which I think that's probably, if I did it, that's probably the only thing that I would do would just be to reduce. But maybe that's not the traditional way.
I thought a lot about this reduction. I had a backtest on this, and if it's a rule, and maybe I remember Niels said it a few years ago. Is it your rule, consistent rule? It's okay, and I agree with this totally. But there are some maybe problems with this reduction of positions where when you get to the normal, back to the normal. And of course, it's not maybe a big problem to do a consistent rule and follow it. So from choose the parameters for this, but I don't do it for me personally.
Yeah, I think the two different approaches, they're almost stunning in their differences, because the way I see Rob's approach, and I think Bruno C. made a really good, valid point there. I actually think that Rob's approach focuses or invests heavily in sample size in an individual return stream. In other words, an individual market. And in this approach where you're volatility targeting, you're taking information from that the market return stream or the market, and you are making an assessment using sample size over what works best for that particular market. So your position sizing scales accordingly on a continuous-based system where if signal strength increases, your investment in that individual return stream increases, and if the signal strength decreases, it reduces. So inherently, as Moritz said, this leads you to different different weightings at the portfolio level because you've been investing heavily in each individual return stream. So that and that's backed up by sample size in Rob's viewpoint. So where I tend to think we significantly differ is we always talk about we target the tails. So what does that mean? What that means is that we are disregarding the sample size associated with a normal distribution. We are disregarding the individual character of individual markets, and we are choosing a method that per market has a very small investment. And the same level of investment for any different market, but we diversify incredibly widely. So any individual market, we only might have 30, 40 trades. In Rob's terms, with his continuous method, theoretically, there could be 1,000, 2,000, 3,000 trades, individual, if you break it down into discrete steps, 3,000 associated with a market. So he's capturing the character of that market. We are disregarding the character of that market because we're only focusing on the tails. So by a process of exclusion, we're saying to ourselves, right, how do we therefore increase our trade frequency at the portfolio level if we are only targeting these outliers? Now, these outliers are statistically can't be sort of measured. So we can't use the principles of a normal distribution or statistical inference to basically increase the validity of our signal. So that what we do is at the portfolio level, we invest across a vast array of different return streams, each with equal weighting. So we're not caught in a trap of exposure in relation to different weightings at the portfolio level, because each of those return streams has an equal weighting, and we are therefore only targeting the outliers, which might only be 3, 4, 5 per return stream, but we might have 1,000 return streams comprising 200 markets at Jerry's stage with 4 systems. That's 800 return streams. That's how he's increasing the frequency distribution of outliers. not the frequency distribution of the trades in the normal distribution. And therefore, through this total different, focus in philosophy, we are targeting different areas of the market distribution of returns, and our result is totally different.
And I think that...
But Rich, does the vol management, does it really add to positions when this relative strength of the trend is greater and reduce positions when their relative strength is weaker? Because if a market was limit up at all-time highs, they would be selling.
Yeah, I don't think volatility targeting to me works for not the type of trends we're targeting. So it works for trends that exist in the peak of the distribution of returns, which are effectively, the way I view it, it's sort of like convergent elements of trends. It's, where properties mean revert and you suddenly get a price move that to many people looks like a trend. Or it's not random trends either. So the trends we're focusing on are these trends that exist in the outlier regions, these dominated by power laws. Those other trends, I think that's where volatility targeting works, because they are bound in the bulk of the distribution of returns, not in the tails. And because of this phenomenon of equilibrium associated with this, variance around a central mean or a central standard deviation, Rob's models work because they're short-term in nature. He's not targeting these massive trends that we're targeting, where we step out into the medium to long term, we exclude the noise and the trades associated with the bulk of the distribution. And we're only focused on the tails, which is the domain where the Cauchy distribution basically reigns supreme.
If you were to order the price movements, it's as if we are focusing on price movements on the extreme tail, on the the most extreme 5%. What these systems do is to focus on not so extreme, on the base of the tail, for the lack of a better word. It's so you should expect more profitable trades, but with a smaller expected return. Right, Rich?
Can I actually interject here and try to answer with Jerry's point, which is, is vol targeting forcing you to sell out of a winner as volatility expands and you're making money? The answer is no. And the reason for that is because your understanding of vol targeting, a discrete system where you have an entry and an exit, and then you do vol targeting around that would be exactly doing what you, Jerry, described. But a continuous signal management in conjunction with vol targeting looks at the balance between volatility in your volatility model, volatility, I'm using it, but I'm pretty sure a lot of people use it, as in your signaling, as a signal function. So as volatility expands, it makes your signal less trustworthy, for lack of better words. So your signal tends to dampen as volatility expands. So you would be tempted to say that yes, you are forced to sell out as this thing moves in your favor, even if you are getting on a good trend. But to counter that, because that is also counterbalanced by the fact that it might be that the volatility you're capturing is actually providing other offsets in the portfolio. So it's never quite that clear cut whether the volatility expansion leads to an immediate cut, to an immediate position reduction. Moreover, there's this other point that I keep bringing about that I call ballast, that Rob calls inertia. If you're trading a continuous system, being vol targeting or not vol targeting, but when you use continuous signals, because the signals evolve continuously through time, and that obviously forces you to trade continuously, which costs money and you should avoid, you have to pick a point and say, okay, my models are free to move continuously, but I'm really going to take a signal if there's a deviation between my theoretical portfolio and my actual portfolio above a certain threshold, 10%, whatever. You can backtest that. That's pretty easy to figure out. So there's this. You guys are right that your system is a lot more simple and a lot more transparent in being able to do this reconciliation that you keep doing. P&L, so return to trade, return to revenue stream. Whereas in this type of vol targeting continuous signals portfolios, you have to always think about the portfolio. So the trade versus the portfolio, perhaps even arithmetic returns versus geometric returns. So it's much more complicated. I don't think it's complex, but it's complicated. So all these attributions should be seen differently. And again, I personally don't agree with the fact that doing vol targeting prevents me from catching the outliers and going after the Cauchy distribution region of price moves, because I've been on good trends. But again, it's one of those things that I cannot scientifically prove. I will tell you that on a trade by trade basis, I'm making less money than you, but probably at portfolio level, I'm catching up, or I'm catching up, and I'm probably coming up pretty much where you guys are.
Hi guys, can I ask you a question about what you think about short-term systems? Because as some other speakers said last week, I trade shorter-term systems, shorter than you guys, and I didn't have such a bad week. But of course, I'm lagging you on a longer term. And I was thinking if you would consider that trading a short-term system is a kind of vol targeting, because you're, in a way, you're chopping the good trends up and down, but at the same time, you're reducing your drawdowns, like it happened last week. So I wonder if you guys see, of course, on the good side, they are not complicated. They are not restricting the sample size. So I was thinking about that as you were speaking, and I wanted to know what you think about that.
I want to say
the
that
thing with short-term systems is that what it does, it might catch outliers, but it also includes a lot more noise and influence from mean reversion. So as you step towards as you get deeper into the bulk of the distribution of returns, towards the mean of that distribution, you'll find that there is a lot more accompanying noise and there is a lot more accompanying mean reversion with your trend following signals. Now, Rob provides that solution in his case that he put on his blog post, because he is investing his efforts as you approach the normal distribution, and he's using different models, that FV model, using volatility targeting to extract obviously a very good edge from that region. But in our zone, in the outliers, we detach any significance between volatility and performance. So we're saying volatility does not equal risk. And the reason we say that is that in this exotic region of the distribution of returns, we think there is a breakdown between the relationship between volatility and risk. This is the assumption that volatility and risk are equivalent is based around principles of Sharpe, Bill Sharpe, with the Sharpe ratio. It's also based around the principles of modern portfolio theory, the efficient frontier, all of these things. So this is where, in the normal distribution, Gaussian methods certainly provide a risk proxy using volatility and risk as being or volatility being a measure of risk. We're saying no, with Mandelbrot and all of those things, we're saying out in the tails, there is no relationship. So for a volatility targeter, like someone like Rob, who's focusing or investing his efforts in the short-term space with supposedly trend-following models, in his view, he's working well because he is using volatility and risk as a proxy, and he's adjusting his position size and his signal strength in accordance with the level of volatility in the market. That's because it's in the bulk of the distribution, a normal distribution. We're saying in our area where the breakdown occurs between volatility and risk, you can't use these Gaussian models. We can't use volatility market, targeting. So we're saying the reason we don't volatility target is because there is no relationship between volatility and risk in the area we're focusing on.
So you think that the original, for example, a shorter term but an old school trend following system is not a volatility control system. It's a valid system, or if it's not valid anymore, it's because of other things.
So in terms of the guys, so I trade short term, all right. So I'm a trend follower. So there's one entry, one exit, one stop loss. So, when we first get into this thing, maybe years ago, these transaction costs were so expensive. And it wasn't actually possible to take thousands of trades over the year. So as a long-term trend follower, if you're trading hundreds, 120, this is much more. The frequency is much more on the short. So this is the difference. And what you're doing is, basically, let's say that you're trading 200 days breakout with 100 days exit on the long term. Okay, so on the short term, you take that 200 days to 100 days system, but this time instead of using days, you use bars, hourly bars, and it works. So if you actually apply the same system to 200-day bars as an entry and 100 days exit. So what you're doing is you're actually diversifying across the time frame. And so what is required to be able to do such a system is, of course, not discretion, but automation. So you need to code it so all the time your code needs to actually trade 7 to 24 hours, so you don't actually need to follow up those individual trades. And so the Niels was talking on his latest podcast, whether if you code a short-term system, is the experience as the same as long-term system? Because on the long term, you open up so few trades that you have a life, work and life balance per se. And of course, if you code it, you actually have it. The same thing happens for you because your code does the job. All right, it's a multi-threaded. So you're using these threads. You can see each thread as a worker. So however threads you're using in your system, it is quite actually up to date. So you use a streaming API, so you use a REST API, so you use a signal generation system, and you're managing this thing with a software portfolio, and it works. There is no reason why trading hourly bars doesn't work with trend system. In my experience, it works, and I'm making money. So really, so that's where we are really. Thanks.
I want to say here that I was a short-term trader for a few years, and I started as a short-term trader, and I want to say that it's very good training, for training, because a lot of different trades and so on and so forth. But first of all, there are a lot of problems with execution of these trades. There is a difference, even maybe a big difference between your backtest and real execution of the trades, especially if you are talking about day trading. Then, of course, as we all know, costs of these trades, it's a problem, and a lot of noise. So maybe in a short-term space, and I had a lot of research on this topic, it can be filtering here. Maybe filtering have sense here, but in the end of the day, I haven't found a perfect solution. And a long-term trade, for me personally, I see that it's more perfect in all ways, in all directions. When you're trading on a long term, it's better. And So I invented filters, did filters, but in a short-term space. But I have not found something that is really good. So in one market regime, I saw how this filter reduced drawdown very good, but in the end of the day, I saw the same drawdown when I did more back tests. So I understood that my choice is a long-term trading, but I not feel sorry that I was a short-term trader because of this. I understood how valuable to be a long-term trader, and I love so much to be long-term, partly because I was short-term.
So thanks for answering my question, Bruno. So I'd never heard that before, that under the vol management philosophy, that as the volatility increases, the signal gets weaker. That's very interesting. And now that probably says more about me, having never heard of that before. And then I was hoping at one point you were going to say that the classic no vol management was more robust. I got my hopes up there. But because, once I was thinking about this last week, I was thinking if you can vol manage and still not sacrifice any profit, then it's almost like saying that the vol management is as good or better signaling trends, when to get in, when to get out, as the breakouts would be. How could this be true? And if vol management is so much better, then just use vol management in some way to signal entries and exits. So by the mere fact that the market increases in volatility, that is a superior signal to exit than waiting for a breakout or moving average crossover. So I guess into that philosophy, though, that is exactly, I guess, what they're saying. I'm out of my league here in trying to summarize, but yeah, it's really funny how, and it's almost like we should just drop the word classic to some degree, because this vol management, portfolio management, is really not trend following. Letting profits run is just a horrible, scary thing. And you're totally out of control. Like, when are you going to get out of some of these trades that have increased vol and that are crushing your P&L? They're going lower and lower. Well, whenever the exit gets hit. Whoa, that is way too hands off for me. I need to wrap trend and momentum with some sort of management of this daily P&L so I can go to sleep at night. So it's really like we're the trend followers, classic or not, and they're more something else, but it really doesn't have much to do with the traditional cutting profit short, which implies a stop loss, and then letting profits run, which implies no vol adjustment.
I will never kiss the classic trend follower ring. Of course, it's just a joke. But I actually thought about whether the classic approach is more stable, and I can say that it is, only if you could make the statement, or if you can make work the fact that you have two equity accounts, closed equity and open equity. And in actual fact, my first foray into trend following, to tell you, how much your approach has been interesting and fascinating to me, was getting Curtis Faith's book and programming up the system in MATLAB and just working with that for a little bit. So yeah, I do think that your system has a lot going for it, and I've been trying in figuring out ways to reconcile the two approaches, because I think if you're growing a portfolio, vol management works, but again, is the trade versus the portfolio that counts, in my opinion. So that's where the difficulty is in finding out the combination. And if I may, I have a question going back to last week, Jerry. You made a very interesting point about when Moritz was talking about single stocks doing the shorts, and you said that you can do a synthetic via selling the put. But the question, I didn't ask it last week, but the question is, you probably need to have certain open interest in that as well. So aren't you sidestepping the problem a little bit? Because if you had enough borrow for a short, wouldn't you be better off just doing the short in stock rather than doing it synthetically? Sorry to interject, but that's the question.
Yeah. Well, before I forget, when I stop talking, please repeat your joke because I missed it. So, anyways, because this, the only thing more important than trend following on this trend following spaces is the jokes, and so for me, anyways. So don't forget to repeat that joke you made. But so going long and short, buying a put and selling a call at the same strike price would be a synthetic short, future. And if it's a relatively liquid stock, at the money, it should be really liquid, the call and the put. And liquidity, and I'm not an expert on this, but liquidity is a slightly separate subject from the broker that you use having the inventory of a certain stock that he can lend it to you. So that is not the same thing. So if your broker, it's theoretically possible your broker doesn't have any Google to lend to you. And it's highly unlikely, but if you get down to something that trades 300,000 shares a day, which I am all over those stocks, 300, 200,000 shares a day, depending upon the ATR, that's going to be sufficient for me. But whether my broker IB can lend that to me and at what interest rate, it's more specific to the broker than it is to whether the stock is liquid enough.
Yeah, thanks. I think I understand it. No, the joke was that being a sinner, I will never kiss the classic trend following ring.
Yeah, I don't know where that ring is. But yeah.
Just a quick question. So, in terms of wall management, what about the communication side of the things to institutions? So, even among traders ourselves, we are pretty much, confident where we stand. The impression that I have got from this spaces, Jerry Parker's spaces, is it is rather more cumbersome to communicate this message across the institutions. And at some point, if you would want to work with the institutional money, sooner or later you may end up doing wall management, even though as a trader, you're much better off not doing that. So what do you think about that, guys? Thank you.
Yeah, well, I think that we should probably assume that investors and especially at institutions can understand and appreciate different approaches. And since 90% or close to 100% of the larger CTAs vol manage in some way, throwing one in there in the portfolio of CTAs that doesn't vol manage, I would think that that would be okay, and they could understand that. And then we keep forgetting that, in my opinion, the big benefit of more of a classic approach is the consistent profits. It's it doesn't hold on to trade. It doesn't make money. It doesn't do a good job of preserving capital, preserving open trade equity. It is sort of feast or famine, but it's really highly volatile sometimes. But it is very consistent on an annual basis, and so it does have some things going for it, even apart from diversifying your CTA portfolio. And then I think another thing is that what about the big hedge funds? The hedge funds that are mostly stocks that are down 40 and 50%, and the 8% return in the stock market with drawdowns of over 50%. And all the competition we have, which are given sort of a freer pass on returns and drawdowns, especially if the majority of the investments are stocks. And then you throw in the poor old CTAs, and who can never have as bad a return risk profile as stock only, whether it's hedge funds or whether it's by long indices, because we just trade too many markets, and we do shorts, and we wrap trend following around it. There's no way a CTA you could take a rudimentary trend following system and trade 50 markets. You're going to make more than 8% with a 50+% drawdown. You can't be that bad. It's almost impossible with a diversified portfolio that does shorts and trades trend following. So poor old CTAs get held to this gigantically high standard, and the CTA industry itself promotes that because they are interested in smoothness. And so allocators are going, well, darn, if you're interested in smoothness, well, then I guess I should be interested in it too. I don't hold my private equity people to this standard. I certainly don't hold my stock portfolio to that standard. But if you're willing to say, yes, we should deliver these returns and have a really good Sharpe ratio, then okay, I guess I'll buy that.
For me personally, I'm sure that stability and consistency, it means it leaded by adaptiveness, and I don't know anything that is more adaptive than classical trend following. And as I would say, the truth is easy to check, and we can easy to check, and our investors, potential investors, can easy check. Look at the chart, like Neil said, look at the chart, 50-year chart, and try to find any chart without trends there, and it's impossible. So we can see our adaptive models in work, and it's the best way, I think so, to show how it adapts to the market environment.
Okay, we hit a lull here. Anybody want to bring up another subject or become a speaker? Let me know, and I'll let you take over for a while everybody rests. I can't think of anything else that was on my mind for this week. Yeah, so let me know if anybody else wants to speak.
Jerry, I just want to remind everyone that on the drawdowns, just remember the net position of the trade. So you're in these long-term trends, you're profitable. Yeah, you're giving back, but you're still profitable. And that's what we have to keep at the forefront for these medium and long-term trends for the loose pants.
Drawdown. We must accept that the drawdown is a wonderful thing in the end of the day, because drawdown gives us the possibility, if we look at this in a philosophical way, in a mathematical way, drawdown gives us a possibility to have a profit. If there were no drawdowns, then theoretically we could take $1 United States dollar and make billions of dollars. But I don't know even theoretical ways of doing this. And drawdown makes our profit real. So drawdown is wonderful.
I remember one time I read something from AQR that said about drawdowns that when you have, they were talking about equities, and they said that when you have an equity, you're being paid for three things: for cashing the dividends, for getting the equity risk premium, and for not selling when the equity goes 60% down. And they said the most valuable of these three activities is the third one. So it's the one that must have the highest payment to stick to the plan and to have a drawdown and withstand in it and go and keeping a system going.
Yes, but I think we must find an optimal way of trading, and for me, this optimal way, we know what is optimal way for me. It's a classical trend following, and long term, medium to long term. And when we are talking about short term trading, and I have said this before today, we have a lot of trades, and maybe this drawdown is not optimal. And when we are talking about passive stocks, it's also not optimal for me because it's like Jerry says always, it's 8% average profit and maximum drawdown is near 50%. So when we do classical trend following, we have these optimal parameters. And in this case, drawdown is a very good thing.
I was wondering if there was, or if it would be a good idea to have some kind of product like an S&P 500, but with an overlay of trend following to each of the stocks. Maybe not all because they are illiquid, but to the FANGs or to the first 50 or something like that. If it was ever done.
Oh, can you repeat that?
Yes, because it's said here. I agree that it would be a good thing to trade single stocks with a trend following scheme. So I was thinking if there ever was a product like that, maybe even long only, that will be like a trend following S&P, something that has all or maybe the biggest components, but with an overlay of trend following, and instead of going just for the buy and hold with momentum.
Oh, yes. Very good point. I love that idea. You would think that would exist as an ETF or something where I should do that. I should create an ETF that trend follows each of the 500 stocks. And, also don't forget that a very important component of the trend following model would be to size all those 500 stocks the same way using ATR and not cap weighting. So that I think would be a great product and a fair comparison to the benefits of trend following, and certainly not. I just really dislike people comparing trend following the S&P 500 futures with buy and hold the S&P 500, because trading that one futures market has a lot of problems with it, as we've all talked about many times on Twitter Spaces and Clubhouse. Yeah, that is a very good idea and a refuge for people. And you can have your stocks, and then you can also have some risk control. And with me, you see, I want to not go through a 10-year period where I have to blame subpar returns on the stock market. And I want to have a substantial 30% of my portfolio in the stock market, in individual equities. So if the stocks are the only thing trending, hopefully I can provide some returns, just like when the commodities were the only thing trending, we absolutely provided some good returns. So I think it's up to the CTAs themselves to change their portfolio around and not and really try to create this perfect portfolio, not one that fits in at a 5 or 10% weighting that produces some sort of crisis alpha, which is going to be very random and not that reliable.
Yeah, you will be picking stocks by momentum signals, right? Because instead of having the stocks that, for example, you have on your part of your single stock system, you'll be getting them from the S&P, which by itself is a selection by momentum. And also, I don't know how easy is implementation when you go about going long on the smaller stocks. Of course, I guess that going short, it would be even harder. So maybe it would be something like a long only product. But I don't know if even that way you will get the proper leverage to make it to have it a good KR target.
Yeah, that's right. But you have to remember that if the stock is in the S&P 500, it's going to be liquid. But yeah, the shorting is a problem, and what to do with those shorts. You're trying to basically create a solution for a suboptimal solution. Certainly there's nothing more suboptimal than long stocks only, and then long index or long buy and hold only. So then, as we know, as we evolve and as we do research and as we learn, we're like, oh, okay, I need to do shorts, and then I need to do currencies and commodities and interest rates, long and short. And so you're on this path towards creating the best portfolio that contains all of these different markets and hunting for these outliers. And then you're jolted back and says, well, all I really care about is my long equities. Can you fix that? Can I fix this dysfunctional portfolio you have? No, I mean, I really can't. You're asking me to really limit the solutions here. And so this is the world we're stuck in until CTA trend following kind of takes over and people sort of see once, maybe for the final time, the risk associated with trading one sector long only, buy and hold. And then at some point, this trend following CTAs, hundreds and hundreds and hundreds of markets, long and short, will sort of be the primary component of, that's what I'm predicting, everybody's portfolio.
Yeah, I was one time I was in a macroeconomic meeting, and there was the classic matrix with inflation and growth, and the guy was speaking about the different quadrants. And when he came to the one of the deflationary quadrants, he said the bad thing about this one is that you don't have much instruments to trade it. And one guy who does trend following our team said, well, why don't you short the instruments on the other quadrants? Because the guy was thinking just in terms of long, going from stocks to bonds to emerging markets and doing that circle. And he didn't think about shorting. But going back to the equity idea, I don't know if you can get enough leverage to make it happen. If a broker will provide you with enough leverage to have a reasonable return target, maybe yes.
Well, I know that IB will do about a 6-to-1. The stocks are fairly volatile, so I think in my portfolio, I would need the least amount of leverage to trade stocks versus commodities, currencies, and interest rates. So I think the stocks are very, very hefty volatility. So I don't really know exactly if 6-to-1 would be enough. But when I traded the single stock futures, so I traded single stock futures, and the max there was 4-to-1. They limited that. The SEC kind of would wade into the single stock future regulatory and be in control of it. It was never a CFTC regulated instrument. It was a SEC regulated instrument. So the max leverage was 4-to-1 or 5-to-1, and it had nothing to do with ATR or the risk of the stock. It was totally the notional value. And so when setting up that portfolio of stock only, which I did, I had a trend following stock only portfolio fund, and so let's say if I traded 6 units of risk for the overall portfolio of currencies, commodities, stocks, and bonds, I would trade like 4 units of stock only because it was scary how volatile the one sector was. And in 2013, 13, I was traded. That portfolio was S&P 100, so all 100 of the S&P 100 stocks, and I think I was trading like 4 units, so much less than the diversified, and that fund made 65%. And I think it sort of averaged, twice the exposure of the underlying. And it had a hell of a drawdown in 2014. So I think you can get away with 4-1, and IB gives 6-1. But it's going to be scary, it's going to be because that's what trend following needs to do. So as the S&P goes up over time, during those periods where it's going up, trend following is going to be selling when there's some sell-offs, and then you have to get back in again. And so the only way to keep up with the S&P is to use leverage and trade a bit bigger when the market is trending higher. But then when the market starts to sell off, you're going to lose more. So it's not a fun project to keep that thing alive and keep those drawdowns more normal when you're trading only one sector, which I think would be the same if you traded only commodities or only bonds, or only foreign exchange. So then the question is, well, then why do you do that? Why don't you add them all together? Well, that's what we do, but clients love stock only.
Oh, that's a great piece of info because I never traded a single stock, and I always wanted to do it, but I fantasized that they had a higher leverage. But now that you say that they had less than what IB gives you, that's settled in my mind.
Don't forget Forex either. I was just looking at my performance results year to date, and the USD JPY, that's been the best of all my portfolio for this entire year to date. It's absolutely creamed it.
Yeah, and that's another good example of loose pants. Like loose pants works really well until the trends reverse, and so I think to some degree, what I don't want to get too crazy with my risk budget, but I think to a large degree, keep trade a lot of markets, risk 20 basis points, very conservative on the trade level. We don't move it up tit for tat with open trade profit. We're like, if we're, we keep that trade level as constant and we try to move it up a bit as we book profits. And then the loose pants keeps us in these long-term trends. And I think to a large degree, it's just a function of we make money and we're competitive with our peers because when we peak out on some of these trades, the open trade profit is so large, the drawdown is so painful, but then we end up making more money anyway. And all of that risk and volatility is shifted to these open trades, and we're the best in the world and not eating into this capital, this trade level, this original investment, the $1 million investment, and then we slowly increase that with realized profits and losses. But it is just kind of a very unsettling for most people to trade this way because, in a lot of metrics, it seems that when you do research or people evaluate performance of managers and strategies, they're only able to use the numbers that are in the public domain. So we give them our returns and our equity and our volatility. All of these numbers come from the performance data. So as have access to backtesting and the trades, thousands of trades over 40 years worth of data, we can dig a bit deeper and say, wait a second, let's look
Sorry,
at
Jerry,
these,
but after me.
let's look at some of these internal numbers, and we can dig deeper. But the public is only available, can only kind of evaluate us with the the numbers that are on the performance table. So I think that when we say we preserve capital, that it doesn't look like we do if you look at our performance table.
And I want to say that people like recent performance very much, and I think main reason of popularity of Bitcoin and crypto is that it has a very big performance, a very big run, and people think was talking about this like something magical. And 1 year ago, one guy said to me, "Can you see a Bitcoin? It's magical thing." And I said, "No, it's against the law of investment." And he said, "I want to put all my money in the Bitcoin." I said, "No, it's a bad idea according to the laws of investments." And he said, "Yes, but there are a lot of different another crypto." And I said, "Yes, but it's very high correlated instruments. And if Bitcoin will fall down, the other crypto will do the same." And we have seen this. And I said to the people that if you want to invest in one asset, and people like this idea to invest in something in one asset, invest in land where you can grow the food. And if a massive crisis occurs, and it will be, I think, the food will be very valuable. More than crypto. We were talking about crypto gold, crypto assets, but why not crypto grain, for example? It's a joke, but crypto grain, but it's okay, crypto grain, but we can't eat it.
Hi guys, is it possible to talk about a little bit how you're trading the crypto space? For instance, on my end, I'm very careful of the leverage that I use while trading crypto, and I go long and short. So and I'm sure long-term trend followers are also shorting the cryptocurrencies. And if you're doing that, are you only trading Bitcoin and Ethereum like myself, considering the fact that these are the most liquid assets, or do you trade anything else other than those two? Thank you.
I think it's okay to trade in a crypto world, but it must be one of the markets in our diversified portfolio, not more than that. One of the our diversified markets, if we have enough risk management enough money for good risk management for that, it's totally okay to trade crypto as grain, as euro, as stocks. We apply the same rules to all the markets. I think so.
But not all crypto is liquid enough. So, for instance, when you're trading Bitcoin and Ethereum, you know that these two instruments are quoted in CME, in exchanges in US. So, but not the others. So, I'm just curious whether, as long-term trend followers, are you just completely ignoring the other crypto assets like myself, or do you do something else with them? Thank you.
Yeah, good question. I like the crypto futures, and I think that the Ether and the Bitcoin, I've traded the big contracts and the mini and micro contracts as well.
Jerry, you're going in and out.
I must have a bad connection today. I'm not sure. So I'll keep it short. But I haven't gone into the cash. Is it safe? I keep hearing about the exchanges closing and freezing, and so futures seems much safer. And the SEC agrees with me. They refuse an ETF based upon cash, Bitcoin or Ether, and only approve ETFs based upon Bitcoin futures.
really need Seth and Moritz on this one. They seem to be specialising in those areas. I trade the Bitcoin, but through derivatives, through CFDs. But so my only requirements for any of my markets is liquidity. So that does restrict my ability to trade, all different forms of crypto. So I just tend to actually trade Bitcoin as one of the markets in my portfolio.
Thanks, guys.
All right, so let's go through from anybody else, or if you want to send me a direct message if you have a question. And so this is for people who don't speak a lot. This is your chance to ask a question or make a comment. Go for it. And I'm just going to say that I've tried to figure out this Spaces, and I think all I have to do at the very end is tell Twitter that I want this recording to be saved. So I'm crossing my fingers. If someone else has better information, let me know.
So am I, Jerry. I'm crossing my fingers. I wish we hadn't missed last week's, because that first front half where Moritz was talking about trading indexes and ETFs, I wish we had that recorded.
Hi, Jerry. Thanks. It's Ryan here. Just had a really general question about. So I'm a trend trader, and I don't vol manage, so that should get me in some good books already. But I mainly just trade UK stocks, some US stocks, and I just wanted to know about. I'm based in the UK though, but in terms of getting into more trading futures and things, could you guys recommend me some kind of reading or websites? I know like Rob has done a book, because I understand all the principles and how to position size, when to take a position, get out of a position, but I don't understand specifically with regards to futures, if that makes sense. That's the bit I haven't explored. Thanks.
Yeah, that's a tough one. I mean, a futures broker like IB here in the States that charges low commissions and is sort of set up for all kinds of traders, retail and larger traders as well. And but certainly I recommend the information that's on the internet about the Turtles, Curtis Faith's book, or information was mentioned earlier. But if you understand all the money management, the turtle money management, and the trends and the breakouts and stuff, it sounds like you're pretty much there. So if you're talking about putting on trades, or what's the tick value, and what we used to do over the years, when we would add a market, we would do all that and make sure we had all our ducks in a row and we had the right information to put on the number of contracts that we should. But we still kind of experiment and buy a one lot, and make sure that it was showing up correctly on the broker statement and we had the tick value correct. And so you could, just start small, buy one lots, or go short a one lot, and just to get experience on trading futures, just trade small. But it really shouldn't be too much different than stocks. When I first got into stocks, I had never done stocks before. So I'm like, okay, I think I know what I'm doing here, but I'll just start small. And if I have some administrative issues that I don't understand, I'll make that mistake with a small number of shares.
Oh, thanks very much. That's good advice. I mean, I don't know, just a quick follow-up to that, but I usually, I use a software here in the UK called SharePad, and I use it to kind of scan for kind of pullbacks and breakouts and things that trigger my systems. But I guess for futures, are they all listed together somewhere on are they listed with the stocks, or are they listed kind of? Is there something that groups them, I guess, or is it just the fact that they're classed as futures?
Yeah, I think I would go to barchart.com, and look at the futures markets. They list the futures per exchange, and then you can see the liquidity of each one of the futures. I'm a big fan of Barchart. I will send you a link on my Twitter to the list of markets, the Barchart list of markets. Hopefully, you can get Barchart in the UK. But I love Barchart. It's free, and it has a lot of great information.
Thanks. That's great. Thanks very much.
Alrighty. We'll say sign off, and hope everybody has a good weekend, and I hope this thing records. So if you have any questions or concerns, send me a direct message and we'll chat about it. If not, I'll see you all next Friday, 8 a.m. Eastern Time. Thanks to everybody.
Thank you.
Thanks, everyone. Bye.
Thank you.